Hello, my name is Ahmad Asgadi. I'm talking about for chapter 8, making capital investment decisions for my courses BA 668. And uh, introduction about for the chapter 8. This chapter delves into the principle and techniques that businesses use to evaluate and make decisions regarding long-term investment opportunities. Capital investment decisions involve allocating financial resources towards projects or assets that are expected to generate returns over an extended period. These decisions are crucial for the growth and sustainability of businesses and require careful analysis and evaluation. For next style, I'm talking about for the question. The number one, how do we determine if cash flow are relevant to the capital budgeting decision? Uh, Number two, what are the different methods for the computing operating cash flow and when are they important? Number three, how should cash flow and discount rates be matched when inflation is present? And number four, what is equivalent annual cost and when should it be used? For next question one, how do we determine if cash flow are relevant to the capital budgeting decisions? Cash flow and capital budgeting decisions and cash flow are considered relevant to capital budgeting decision if they are incremental, meaning they represent the additional cash flow that occur as a direct result of the capital budgeting project being undertaken. And in other words, relevant cash flows are those that would change if the project is accepted or rejected. Here are some key points to consider when determining if cash flow are relevant to capital budgeting decisions. Uh, Number one, incrementality, and number two, timing. Number three, consistency. Number four, risk. Number five, sunk cost. Number six, opportunity costs, and number seven, externalities. And for next, okay, I'm talking about for some points about for consider when determining if cash flow are relevant to capital budgeting. Number one, incrementality and cash flow are relevant if they are incremental, meaning they occur as a direct result of the capital budgeting project. This cash flow should reflect the difference between cash flow with the project and without the project. Number two, timing and cash flow should be evaluated based on their timing. They should occur in the future and be directly attributable to the capital budgeting decision being made. And number three, consistency and cash flow should be consistent with the overall objective and assumptions of the capital budgeting decision. For example, they should be based on the realistic revenue projections and cost estimated and market conditions. Number four, risk. Cash flow should consider the risk associated with the project. This may involve adjusting cash flow for risk factors such as inflation, interest rate, and market volatility. Uh, Question two, what are the different methods for the computing operating cash flow and when they are important? And computing operating cash flows, there are several methods for computing operating cash flows, each with its own merits and importance depending on the specific context and objective of the analysis. The primary methods include number one, direct method, number two, indirect method or reconciliation method, and number two, free cash flow, FCF method, and number four, EBITDA, earning before interest, taxes, depreciation, and amortization, and number five, cash flow margin. For next style, I'm talking about for primary methods, and number one, direct method. The direct method calculated operating cash flow by directly summing cash receipts from sales and other operating activities and subtracting cash payments for operating expenses. This method provides a straightforward and intuitive view of cash flows generated from core business operation. It is important when detailed insights into the sources and uses of cash required, as it breaks down cash flows by specific categories. Number two, indirect methods. The indirect methods start with net income and adjust for non-cash items such as depreciation and change in the working capital and other non-operating items to arrive at operating cash flow. While it is more commonly used due to its simplicity and reliance on readily available financial statements, it does not provide as a detailed view of operating cash flow as the direct method. However, it's important when direct cash flow information is not available or when reconciling with reported net income. And next style, and I'm talking about free cash flow, FCF method. Free cash flow represents the cash generated by a business after accounting for capital expenditures necessary to maintain or expand its asset base. It is computed by subtracting capital expenditure from the operating cash flow. Free cash flow is crucial for evaluating a company's ability to generate cash for debt repayment, dividends, share purchases, and other uses. This method is important for assessing a company financial health, growth prospects, and ability to generate shareholder value. Another method and EBITDA, earning before interest, taxes, depreciation, and amortization. EBITDA represents operating profit before deducting interest, taxes, depreciation, and amortization expenses. While not a direct measure of a cash flow, EBITDA is often used as a proxy for operating cash flow because it excludes non-cash expenses, depreciation and amortization, and financing related items, interest and taxes. EBITDA is important for comparing operating performance or companies with capital structure or tax situation for assessing profitability trends over time. For next, I'm talking about for question 3, how should cash flow and discount rates be matched when inflation present? When inflation is present, it's important to match cash flows and discount rates appropriately to ensure accurate valuation and decision making in capital budgeting or investment analysis. Here is how cash flows and discount rates can be matched in the presence of inflation. Number one, nominal cash flows and nominal discount rates, real cash flow and real discount rates, and inflation adjusted cash flow and discount rates. The choose between nominal and real cash flow discount rates depends on the objective of the analysis and the preferences of decision makers. Nominal cash flows and discount rates are commonly used when considering the impact of the inflation on cash flows and investment returns, especially in environments with significant inflationary pressure. However, real cash flow and discount rates may be preferred in certain situations, such as when the focus is on the underlying economics fundamentals of the project or when comparing investment across different inflation environments. Question 4, what is the equivalent annual cost and when should it be used? Equivalent annual cost, EAC, is a financial metric used to evaluate the cost of an investment or project on an annual basis, allowing for easier comparison with alternative investment opportunity. EAC represents the analyzed cost of owning, operating, and maintaining an asset over its useful life, considering both initial investment outlay and ongoing costs or benefits. Calculate the equivalent annual cost, EAC. The first step, determine the initial investment outlay, including any installation or setup costs required for an investment or project. Step 2, estimate the annual operating and maintenance costs associated with the investment. Step 3, calculate the present value of these cash outflows over the investment useful life using an appreciated discount rate. And now, step 4, convert the present value of this cash outflow into an equivalent annual payment over the investment useful life using annuity formulas or techniques. And last part, and EAC is particularly useful in the situation where, and number 1, comparing investment alternatives, and number 2, evaluating lease versus purchase and decision, number 3, assessing long-term projects, number 4, evaluating equipment replacement, and number 5, projecting life cycle costs. Thank you for attention to me. Bye.